Ryan Hussey with Zaner Ag Hedge, bringing you our strategy of the week update here for October 21st, 2021. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. The big story today, I think, was some of the volatility we saw in the soybeans, closing down 21.5 cents there in the November contract, down 21.5 there in the Jan 22 as well. We're going to be looking further out this week. Again, over the last week, we shifted that mindset from really having more put protection to rolling that into long positions. If we had in the money puts, we were able to buy futures back over this last week against those puts and maintain a positive delta for the upside in that exposure, or get out of the puts and start looking at call spreads that allow us to have some of that reownership now that prices have broke to levels that seem like there's some value now that we've started to formulate a capitulating low and started to move a little bit higher off those levels. So with that being said, let's take a look at the US dollar index to start. I think that the story kind of begins there for the week because, you know, as we're starting to see a potential harvest low form, maybe some export markets start to pick up here. We're going to continue to want to watch and monitor the US dollar for weakness or strength because a weakening US dollar can help influence our export trade partners, to the same tune that lower prices can, to start getting some of that export business done. So the US dollar looks like it might have topped here in the near term, getting as high here as 94.50 before rolling over in a multi-day downtrend. We're now back below the 18-day moving average. Our 100-day moving average is still below us, down at 92.65, the 200-day down at 91.85, and the 55-day at 93.23 here, and very well spread out in a nice, kind of bullish formation. The market could still turn higher, and if we do get a rally in the dollar, look for resistance up towards that 96 area. That's old support from the old range the dollar was in. It's also 50% area, retracement from the 103 highs from last year to the lows of this year. But if the dollar is turning over, if we're going to start to break below trendline support, we would need to head down to a test of 93 at this point, which we would need to see some follow through in the chart. And the dollar actually trading a little higher today could have been a reason we saw maybe a little bit of weakness across the board and some risk off. Maybe that risk off across the board, I should say, in commodities and a little bit in the S&P there today is a reason we saw some dollar strength. I know we saw the 10-year and the 30-year, the treasury markets sell off a bit there. That usually adds to dollar strength because at some point that resembles is the market looking for higher interest rates, which effectively creates more value for the U.S. dollar as a currency, relative to other things. When there's yield involved, the value of a currency or any asset goes up. So that being said, let's take a look at that daily chart for our November soybeans, trading at 12.24 last. We're starting to get to the end of life here for November beans. We'll be looking at that Jan contract trading at 12.33 last, but both down, moving in lockstep. But they are at about, a 6 or 7 cent, 9 cent spread there between the two contracts, with the Jan at a 9 cent premium. Outside day to the downside. This is our first outside and red day, and certainly down day with lower lows and lower highs. I guess it wasn't a higher high, was it? But it was a lower low and an outside day to the downside here for November beans. Pretty bearish close, if you ask me, on a test of the 18-day moving average, and pretty harsh rejection there. 1260 is where we had some trendline resistance. The next moving averages we have above us are the 55-day and the 200-day, up there around 1285 and 1283 respectively. There's also a trend line there that is coming in as resistance, and arguably a failure to even test that high could spark this as just a dead cat bounce on this chart, because we are only bouncing back up. I hate to be the bearer of bad news at this point, but we're only bounced back up to test the old June lows here around 1240, and then that cluster of lows that we had there in late August through September. That we're kind of came down as low as 1260 there, down to 1257, 1258 about was the low. So we've only come back up to there to test that broken support now as resistance. Not a great look here in the near term. But that doesn't mean we can't be forming a harvest low or could be bottoming to some degree. It's just it's something to maintain and keep an eye on. And certainly we've got some resistance now on our 4-hour chart of soybeans that we need to break above. And if we go above, we feel more technically bullish on this chart. So old trend line resistance here broke back above that level around 1220 yesterday. We could be coming back to test that broken trend line now as support. The trend line support that we saw through this week and from last week through this week did give way today here at 1234, and we got a swift technical reversal to the downside, trading down to new lows of the day there for November beans. Full 50% retracement from our 1184 lows from last week to the highs of today at 1249 comes in at 1216.75, man, we almost got down to that 50% retracement. So look for, in the overnight, maybe a quick test of that level and a reversal higher. If we get that kind of price action, well, we know what's at work here and what kind of technicals are at play. Upside, we'd look for the next push in the soybeans to get up to 1260 to 1270 for a real test, I think, of some solid resistance. And I think there's some moving averages, some other things that the broader market would like to see tested at this time to really constitute a breakdown. Because so far on this chart, this looks like some capitulation to me, a move below $12 that was unable to hold down there. We retested the breakout levels from last year and to start this year, held them as support at this time. So I think this market probably has a little more short covering here yet to do before it's done. But, we'll see tomorrow, and how price action resolves from this sell-off here today is going to be pretty distinct for what we're going to be looking at going forward. So in the soybean market here, we've been talking about, and I know last week we mentioned, I think I started to mention this one last week, but certainly this week, one of the trades that we've been talking a lot about and making the recommendation for, I've been making the recommendation for, there we go, is the 1260 here in the January soybeans. So there's 63 days until expiration here. The 1260 calls, we're picking those up. They cost you around 24 cents here the way we settled the day. We're turning around, though, and selling the 1360 calls here for 5 3/8, getting that all done there for around 19 cents total cost, so below that 20-cent cost mark for a dollar wide spread here in January soybeans. There's 63 days left. The January beans trading again at 1233, almost a 10-cent premium to the November, but at 1233 puts that spread less than 30 cents out of the market, and I think is a good way of getting the toe in the water. We were looking at 1350 last week when things were a little lower. I think the 1360 call spread still has value there. And if we get a massive move higher in the soybean market, you're able to capitalize on that and still, get a potential dollar out of that move. If we, get above that 1360 strike, and you end up in the money on these options into their expiration 63 days from now. So, something else you can look for, at this time is honestly, we've pulled back enough in this market where, potentially looking at a long futures position on this dip is not a unreasonable risk reward type scenario. I would be looking to be a buyer down into the 1220 area here for November soybeans. This pullback and into the 1230 area maybe for the January soybeans if you want to go further out and not worry about a roll. But this area of support now into this 50% retracement into the 1216 area, that's an area that I'm interested in now, because if we're starting to trend higher, going 2 steps forward, 1 step back means a 50% retracement, and then we'll take 2 steps forward again. That'll take us up to the 1260 to 1270 area, and we'll be progressing higher, and we will have been able to have got into a trade with defined risk. Risking 15 cents from here, putting a stop below $12, even a stop below the lows of the month at 1284, you have finite risk there of 10 to 20 cents, which, if you don't want to use a stop in the market like that, you can be going potentially long a future here and turning around and looking at our option market to manage the risk through a weekly option. Here we're looking at the January, well, it's the October, but they're off the January contract. It's the October week 5. Okay, October week 5. They have 8 days until expiration, so a week from tomorrow, expiration here on them. The 12. So again, it's off the January contract. So if you're going long January soybeans at 12.33 or 12.30, using the at the money put here is going to cost you 12 cents. Using a 12.20 put, however, which has 13 cents of risk to the downside in terms of where you'd be getting long at the market in the January soybeans at 12.33. The 12.20 strike has 13 cents of risk to it, plus the 8.25 cent cost to own that strike for the next 8 days. That's going to come to a total of 21 cents of risk. Well, there's 21 cents of risk from 12.33 to the lows in the January bean chart. So, or to the lows, excuse me, that we'd want to see the market stay above, I should say, at that 12 to 12.10 threshold. It's around 12.10 for the Jan beans, but that's a way of limiting our risk to 20 cents to the downside to basically be long of futures at this market without having to put a stop all the way down 40 cents below us, which again, from 11.84 lows in November to the 12.23 highs, that's 40 cents of risk, not 20, excuse me. So, but here's how we can get it done with a 12.20 week 5 October put against that long call option. Against the long future. Again, you can use that 12.20 put October week 5 for about 8.25 cents, and at a total cost of around 21 cents of risk. You can have finite risk of being long a future for the next week. And if we're right about the market turning from right here, as we suspect it will, it'll go higher and won't really look back. If we're wrong, you're only out 21 cents. That costs you to own that option and the strike difference between them. So, all right, well, let's take a look now at December corn. Soybeans, hopefully we'll start to see some exports to justify some of the reactions and the moves we've seen in the market. I've been a little disappointed here myself that we saw today is in terms of volatility. You want a market to go straight up. You'd want to see a market go higher with some export, demand where we have justification for kind of the whole narrative that we've been talking about for the last couple of weeks. And it seemed to have begun last week with those great exports we saw in today's weekly export number. Those flash sales out of China of over 54 million bushels really helped propel the trend over the last week. But without that news to feed the bull here, obviously we're starting to see some profit taking against that trend. Now, if support holds, we start to see a reason, technically, fundamentally, whatever, the trend continue. That remains to be seen, and we'll see. There's a line in the sand here for the market to defend. So anyway, December corn finishing down 7 cents today, but inside yesterday's price action. So we did not actually break to a new low here for December corn. And unlike the soybeans, December corn's actually holding above its 18-day moving average here. A fight between that 18-day and the 55-day moving averages at 532 for the 18-day and 536 for that 55-day. The 100-day moving average, we are very comfortably below there, which is at 546. And really, when you take a big step back in December corn, you look at the market, boy, this looks like a big wedge, looks like a big pennant. It looks like a big continuation structure where if market was topping, we would have topped and been heading lower by now. This feels like the market trying to and being very comfortable at staying above $5 now. There's only so much only so much time that you can spend doing that before it eventually decides, okay, when do we want to test $6 again, or test below $5 and have a breakdown and maybe a more prolonged trend lower. But for the time being, it looks like we have tested the 200-day moving average, tested our support, come back off that area, and over the last 5 days, we've been trading higher back inside the range we've been in for December corn. December corn typically finds its way back to the 550 to 555 area. We haven't seen that happen yet, but I'm pretty confident that a break above today's high, and certainly a break above that, back above that 50 to 5-day moving average for a move towards the 100-day, we'll probably see corn and December corn take us back that way. So breaking down the 4-hour chart for us now, a trend line support here against the lows over the last week has finally broken. The same level broke on the beans. We saw a much swifter move that took out the lows of the day from yesterday's. Corn did not do so. We held that supportive area and arguably closed a few pennies off the low, still having made lower lows, or not higher highs, but had making higher lows. Yesterday was an outside day to the downside, or outside day starting to the downside, but finished higher. Today retracing, but not overtaking that move to the downside was a pretty positive move for corn, even though we closed down nearly 7 cents. Back above trendline resistance here for the start of October kind of puts me into the camp that we are inside of a range here between $5 and $5.50 at this time. So we probably have a little bit of pressure to go, and maybe another test of $5.50 just from a range-bound markets perspective. Support at the 50% level from our latest swing low to the high here is at $5.23, but I would kind of expect us to stay above $5.30 at this time if corn's going to be heading higher in this trend. We don't really want to see, it's more of a freight train, and you don't want to see it really rolling over. Beans can be a little bit more volatile and snap back, but corn, once it begins a move higher, it typically doesn't give back many of its prior day lows, and that's something we want to see continue higher here in the near term. So how do we tackle this and start to look maybe at some strategies for corn to the upside? Because, hey, over the last few weeks, we've been pretty, I don't want to say bearish on the grains, but we were looking for that capitulation, that move lower. Corn got its move lower, it seems like, in its September WASDE report. The October WASDE report was the beans opportunity to capitulate below $12 when corn capitulated below $5 there in September. So, this latest pullback was a good opportunity to obviously get long. It looks like, given that we were already 30 cents off that area, but I still think there's going to be some opportunity going forward and certainly into the new year that we want to look at and consider. One thing we've been looking at is, instead of paying for all of that time value to get out towards a March time frame here, we can look at the January options. They're off of the March contract still, so we're still trading that March corn for next year, trading at 541 last. So again, they're at a 9-cent premium here to our December 21 contract. That spread will be an interesting one to watch as well, but in terms of calendar spreads go. But not to get off topic here, because we want to talk about those January options where we can pay less in time value, but still trade off the March contract. So March trading at 541 corn, we're looking and have been pricing out here this week 560, 610 call spreads, a 50-cent wide call spread here with 63 days left on it on the Jan expiration here, Jan 22 expiration for corn, 63 days left on it. For off of the March contract, going for, looks like 8.5 cents. The 560 calls costing you a 12-cent premium there out of pocket to buy. We're able to bring in then by selling the 610 calls 3 3/8 cents, getting your cost down. I know 3 3/8 doesn't sound like a lot, but it negates some of that time value. And honestly, this is the type of strike, the 610 call, just like maybe that 1360 call we talked about in the soybeans, we might look to buy back if we see either a little bit more sideways price action, which, hey, if you look at that chart of December corn, remember, we're pretty well sideways. If you look at that chart here, we're pretty well sideways in the market since mid-September there. So for a month now, we've been going between 505 and 545 pretty well, that's just been what we've been doing in December corn. So Having that sideways price action means there's going to be time decay, and being able to buy back that 1610 call for less than a penny. Okay, that's 2 free cents that covered the cost of the trade, and are cutting down on some of the costs there altogether on it. But more important to have that type of short call on in a soybean option spread right now, where there's a little bit more premium than the bean corn. But nevertheless, you can still cut down on a January spread here. Certainly, if you took this same idea and put it out into the March options on the March futures there, and we're paying for another couple months of time value, selling that call even more important in some of these instances, because it cuts down on so much more of that theta decay that is always working against you in any option strategy you have on. And that's something that is often not discussed enough with options. It's usually the reason people get left with maybe a poor taste in their mouth from an option strategy, where they didn't realize how time is working for you or against you. Typically, speaking, when option strategies rely on selling options, you have a limited risk, and we have bad taste in our mouths from having bad experiences of being overexposed in risk, where we didn't realize we were stepping in front of steamrollers to pick up pennies. In other instances, we're left with time decay and options that just go worthless, where we weren't managing either managing the long option strategy well enough to understand that, hey, we need to roll these strikes to ones that are going to be obtainable at expiration if we're holding them to expiration, or get out for the premium that it's worth now, so that we don't just give it away and lose it. Well, selling premium in a call spread or put spread strategy helps negate some of that right off the bat with the initial risk that you're taking in the strategy itself. So, and oftentimes is a way that we like to put our foot in the water, start picking a bottom, start managing reownership strategies using call spreads, because it has the lowest risk profile there are for our producers, where we're always trying to keep that finite risk as a mainstay of the trading philosophy. So let's look at our Chicago wheat here. Much more of a range-bound market than I think we've been expecting. Can't really break above the 750 here, kind of like corn, reverses on the day, but still actually is our one row crop that made higher highs and higher lows, even though finishing down 8 cents on the day. It's just like wheat, to break out above, it felt like that 18-day moving average, only to come back and kind of test a channel support. No real break here on trend lines for the wheat on a daily time frame, just a negative close. And one might argue that wheat here only closed negative because the other row crops did, and it's still trending higher. I think a continual weakening of the U.S. dollar is going to force U.S. wheat prices to continue to rise to try to offset some of that positive purchasing power that foreign exporters now have for our wheat products. They have additional discount basically on our wheat price. So wheat prices need to go higher to ration out that demand away from the international export market. In other words, if prices go higher for the smaller U.S. stockpiles, it doesn't matter how weak the U.S. dollar gets. If wheat prices go to $20 a bushel, the U.S. dollar would have to move considerably to make that competitive on the international scale. You could probably get wheat much cheaper from Russia, and even China might sell you wheat if our wheat prices went to $20 a bushel. But nevertheless, wheat prices seem very comfortable above 740 at this time, seem very comfortable above $7. And we seem to be forming a range here above 720 but below 750. Very comfortably, haven't even tested the 200-day moving average at 684 now, but we haven't been around that 200-day moving average since July. The 100-day moving average at 706 currently continuing to creep its way higher. The 55-day moving average has proved support here for the month of October here. Right now it's 727, and again, we're still above that 18-day moving average at 734. So on a 4-hour time frame, our Chicago wheat today, again, still really holding, in my opinion, above and I mean, I would just call this flat out channel at the end of the day that wheat is holding right now off of that mid-October low. We held a 50% retracement. This is a good situation where we can talk about a kind of a nesting or 250% levels, or the market maybe starting a trend higher, and what it kind of looks like and how progress looks with higher highs and higher lows in almost every time frame since mid-September. Um, the swing from that mid-September low through the October high here, um, the full 50% level held around 720. We've got a reaction on the chart. We broke above trendline resistance. The market's now channeling higher. Inside that area, and from that swing low at 712 to the recent high at 752, the 732 full 50% level. If we continue a little lower here, we're within 10 cents of that. We could test that as support before continuing higher. Trendline resistance against the highs here comes in around 752. So if we start to break above that level, that's the breakout line. Where if we go above 752, I think we're going to be heading towards $8, $8.20 for Chicago wheat. But to that same point, if we start to break below 730, certainly below 712 at this time, we have a trendline support that if we break below, I think that the market could accelerate lower down towards 660 and see lower prices pretty quickly. So the best way I feel like to tackle wheat at this time is looking at option strikes around that 750 to 760 area, using the shorter time frames. It's hard to play wheat past the December time frame, in my opinion, right now. I like looking at it month to month, but we don't have to go all the way out. We can go a week or two out with these weekly options that I like to look at times when I don't want to necessarily get involved with a futures contract, but I do want to get involved with the market and have something that can go have a very high delta very quickly. In other words, it can go in my favor because there's so much such a short time window between now and expiration on it. That delta on it will pick up very quickly and it'll behave like a future. And if I'm right about one of these options by 20 or 30 cents, it's almost like having a futures contract on without the futures risk. So the expiration here, 1 week out. These will be our week 5 Octobers. They're still off the December wheat. So 741 trading last here for December wheat. It costs you 11 cents to buy an at the money call. I would again go out to the 750 or 760 strike, maybe the 755 here for 5.5 cents. That seems to make sense to me. That would be a breakout above that breakout line I talked about. If we go above 760 now, you're making all the pennies above that line for owning a 755 call for 5.5 cents or 5 5/8 cents here. That's where I think I would live over the next week. You could take that out for a trade here that goes 2 weeks out from here. Those are the week 1 Novembers. That 755 strike, not a bad value there at 9 3/8. I like that a lot, actually. Gives you another week on it. Yeah, you got to get above 760, but basically a break above the highs of the month of October right now for this week 1 November call. You'd be making penny for penny on a move above that strike before this goes off in 15 days. Not much time left on the clock, but if you're going long a futures here anyway, looking for that size of a move, that dynamic of a move over the same time frame, this is a way of getting that same type of idea for limited risk in the market. So we'll see what happens there. Let's take a quick look, I guess, before we go and wrap the day all together. Take a look at our December lean hogs and our December cattle. Little disappointing here. We're caught between, I think, the 55-day and 100-day moving average and the 18-day and 200-day moving average. Basically, this 128 and 130 range we've been stuck in. I'm fearful that cattle have been unable to break out. We've seen kind of a downtrend in the box beef cutouts recently. Exports have been okay, but we've got a cattle on feed report this weekend or this Friday after the close. So cattle might be pretty muted and then just open up higher or lower next week. I hate how they trade like that, but that could be what we're left with, just stuck between 130 and 128 here into that news. So I don't really have much to do or say. I was an owner of 128 and 129 calls. I've honestly gotten out of all of those this last week because, fearful basically if it can't go up and continue to go up, it's going to start to come down here. And I fear that that's kind of what we're starting to see now on the charts in the short time frame. The 4-hour chart here, you can see we broke, all the trend lines you could draw as support here. We're basically now range trading between 131 and 128. And if we start to break down and retest lows, there's not much here to save us. I mean, we're going to go through lows here and be kind of in free fall, back to who knows where and quickly. So we'll see what happens there. Lean hogs. Very disappointing breakdown here in the December contract today. Breaking now down below that 77 figure, filling the gap. Filled that gap at 77 rather quickly. Came down here to fill the gap at 73.60 rather quickly. I guess you could call this one big old range still between 90 and 70, and we're still carving that out. Now that we don't have any open gaps on the chart, I would definitely look to this being more of a range, but if this is a channel lower, we could be heading down for a test of 70. But again, at that point, we'd be about as far away from the price average, and a reversion to the mean would still call for a move back towards 80 in this area. As again, the 200-day moving average is up around 78.35. We're below all of our moving averages and starting to drag them lower. We'll see if they turn lower and they continue that way. But I don't have much to do or say about this. There's been a big decoupling from the cash market in terms of the price of December hogs, and it's without, I think, a firming up of our cash markets and that poor cutout, it's going to be a tough market to track here. So with all that being said, keep an eye out here on the November and the Jan beans. See if this is a pullback to buy. We're starting to form that seasonal low and find some capitulation here. We could be very well finding a low on these charts. And I think there's a pretty safe way to start looking at getting that ownership going here. Looking at 1260, 1360 call spreads, looking at owning futures and outright weekly puts against them to manage that risk altogether. Corn, again, only needing to look maybe 50, 60 cents wide on a call spread there out into January, negating some of that time value you'd have to pay for, but still being able to get out into a March position. All good ways to, I think, start getting the toe in the water. And hopefully we'll see those exports start to pick up. Watch for those flash sales from China and Mexico over the next couple weeks. They're going to be the big drivers of our corn and soy markets, in my opinion. And then, of course, watch that U.S. dollar, because as we start to turn lower, and if the Dixie starts to fall apart, that can basically be a reason and have the same effect as lower prices can on exports. So with all that being said, thanks for joining me, everybody. I can always be reached over here at Zaner, and love to continue the discussion with you in more detail about how we can turn some of these trades I've talked about and ideas into real actionable trading strategies for you in an account over here at Zaner. So give me a call at 312-277-0110. You can always find us here. Many of you already know that, but find me on Twitter or Facebook at DanSOTD, or shoot me an email. Thanks for joining me for the Strategy of the Week webinar here this week on October 21st. Stay tuned for the rest of the week to see how things develop. If we do start to get that low, I'll be certainly yelling it from the rooftops that I think that bottom is formed, and we would be expecting to see a retracement back above the levels that we had here over the last week, back above that 1250 area pretty quickly. So have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone. There's no experience with the Packers, and they own Lambeau Field.